The stock markets closed at record highs on Tuesday, with both the S&P 500 and Nasdaq reaching new peaks, driven by optimism fueled by moderate inflation figures that boost hopes for a possible Federal Reserve interest rate cut soon. But here's where it gets controversial. Are we truly out of the woods, or is this excitement just another temporary surge fueled by mixed signals? To start with the details, the S&P 500 climbed by approximately 1.13%, while the Nasdaq advanced even more, by about 1.39%, both ending at their highest points ever recorded. The Dow Jones Industrial Average also saw a solid rise of around 1.1%, finishing above 44,458 points. The key catalyst? Fresh economic data revealing that inflation in July increased modestly by 0.2% month over month, and is slightly below what experts had anticipated for the year. This has sparked renewed confidence among investors that the Federal Reserve might decide to lower interest rates at their upcoming meeting. Specifically, the yield on shorter-term U.S. Treasury bonds, which serve as a benchmark for future interest rate expectations, dipped slightly. Traders are now assigning nearly an 89% probability that the Fed will cut rates by 25 basis points this September, a significant shift in market sentiment. As Catherine Bordelmay from Goldman Sachs Asset Management explained, the recent CPI data offers a positive outlook for equities, indicating that the economy might experience some relief from inflation pressures while still maintaining growth. Big tech stocks led the charge, with Alphabet, Google's parent company, rising 1.2%. This increase was partly driven by Perplexity's lucrative offer of $34.5 billion in cash to acquire Google's Chrome browser, a move that highlights ongoing competition and innovation in the tech sphere. Meanwhile, Intel Tech took a 5.6% leap after President Trump praised its CEO, Lip-Bu Tan, during a recent meeting, a sharp turnaround considering Trump had previously called for his resignation over alleged conflicts of interest related to Chinese business ties. In broader market movements, the Dow's gain of over 483 points clearly reflects investor confidence. The S&P 500 and Nasdaq also made notable advances. Driven partly by optimistic trade developments, the U.S. and China extended their tariff truce until November 10th, avoiding new tariff hikes for now. Such easing of trade tensions has supported the recent rally in tech stocks, along with robust earnings reports in the technology sector. Additional sectors mirrored this upbeat sentiment. Small-cap indices like Russell 2000 rose nearly 3%, and airline stocks jumped over 8%, influenced by a 4% increase in airfares during July. Banks also gained traction, with the S&P 500 Banks Index climbing 2.1%, largely supported by expectations that a steepening yield curve will benefit lending profits, as banks borrow cheaply and lend at higher rates. However, not all news remained positive. Cardinal Health shares fell sharply, around 7%, after announcing its acquisition of Solaris Healthcare for nearly $2 billion, which analysts viewed as a weak move amid broader market optimism. Amidst this, concerns about the quality and reliability of economic data persist, especially after the recent firing of the Bureau of Labor Statistics head by Trump, following downward revisions to official job figures. The market continues to watch for developments around potential nominees to key economic agencies' leadership positions and to the Federal Reserve's top role. All in all, recent inflows into U.S. stocks have been the strongest in 2 years, with record numbers of new highs on major exchanges. The question remains, will this rally sustain? Are we merely riding a wave of short-term optimism? Do you think the economic fundamentals support this surge? Or are there underlying risks that could soon pull the markets back down?